Hello, and welcome to our deep dive into the world of finance's darkest secrets. In this video, we'll explore the gripping stories behind 10 of the most notorious financial scandals in history. From the feverish mania of the tulip bubble in the 17th century to the earth-shattering collapse of Lehman Brothers in the 21st, these scandals have left an indelible mark on economies, investors, and public trust. Join us as we uncover the hows, whys, and consequences of these financial calamities that have shaped the course of finance and ignited critical debates about ethics, accountability, and the perils of unchecked ambition. The South Sea Bubble, 1720, how it happened. The South Sea Bubble was a speculative frenzy that swept through England in the early 18th century. It all began when the South Sea Company was granted a monopoly on trading with South America. To entice investors, the company offered shares, and the prices soared rapidly as people were drawn into the promise of lucrative returns. However, the company's actual trading activities did not support these valuations, and it was essentially a scheme to enrich a few insiders. When the truth was revealed, the bubble burst, leading to a catastrophic crash, ruining countless investors and tarnishing the reputation of the financial markets. Damage to the public. Many investors, including both the wealthy and common people, lost their savings and investments. This financial catastrophe had a severe impact on the public, leading to economic hardship and a loss of trust in financial institutions and investment schemes. Punishments. Some company directors were fined, but the financial regulators of the time were also implicated in the scandal. Tulip Mania, 1637, how it happened. Tulip Mania, which occurred in the Dutch Golden Age, involved the speculative trading of tulip bulbs. Prices for these flowers reached astronomical levels as demand outstripped supply. Investors saw incredible profits to be made and engaged in frenzied buying, which drove prices even higher. However, the entire market was based on speculation, with no underlying value. Eventually, the bubble burst as people started selling their tulip bulbs, leading to a massive crash in the market, resulting in financial ruin for many. Damage to the public. When the tulip market crashed, many investors lost their entire fortunes. This had a profound impact on the Dutch economy, causing financial turmoil and widespread suffering. Punishments. There were no formal legal repercussions, but the Tulip Mania serves as a historical example of irrational exuberance in financial markets. The Enron Scandal, 2001. How it happened. The Enron scandal was a result of corporate fraud involving a complex web of deceit. Enron's executives engaged in creative accounting practices, inflating profits and hiding debt through off-balance sheet entities. The company manipulated financial statements to maintain the appearance of profitability, which, in turn, boosted the stock price. Meanwhile, top executives were selling their Enron shares. The truth emerged when Enron filed for bankruptcy in December 2001, leading to massive job losses and devastating financial losses for investors. Damage to the public. The Enron scandal had a wide-ranging impact, resulting in significant financial losses for investors, the loss of jobs for thousands of employees, and the erosion of public trust in corporate governance and accounting practices. Punishments. Several Enron executives, including CEO Jeffrey Skilling and Chairman Kenneth Lay, were convicted and sentenced to prison. The Bernie Madoff Ponzi scheme, 2008, how it happened. Bernie Madoff orchestrated one of the most extensive Ponzi schemes in history. He attracted investors by promising consistently high returns with low risk. However, instead of investing their money, Madoff used new investors' funds to pay returns to earlier investors, creating an illusion of profitability. Madoff's scheme went undetected for years due to falsified statements. When the financial crisis hit in 2008, some investors attempted to withdraw their funds, and the Ponzi scheme collapsed, resulting in significant financial losses for thousands. Damage to the public. The Bernie Madoff Ponzi scheme was one of the largest financial frauds in history, defrauding thousands of investors, including individuals, charities, and pension funds, who collectively lost approximately $65 billion. This led to financial ruin for many and significant damage to public trust in financial institutions. Punishments. Bernie Madoff was sentenced to 150 years in prison in 2009 and passed away in 2021. The Lehman Brothers bankruptcy, 2008. How it happened. The Lehman Brothers bankruptcy was a pivotal event in the 2008 financial crisis. The firm's troubles stemmed from excessive investments in mortgage-backed securities, high leverage, and inadequate risk management. As the housing market collapsed and the value of these securities plummeted, Lehman Brothers faced insurmountable losses. The inability to secure a bailout or find a buyer led to the bankruptcy filing, which had far-reaching consequences, including a global financial meltdown and economic downturn. Damage to the public. The bankruptcy of Lehman Brothers triggered a global financial crisis, causing widespread economic turmoil. It resulted in job losses, home foreclosures, and a severe impact on public trust in financial institutions and markets. Punishments. The company filed for bankruptcy, and while there were legal actions and regulatory changes, no specific individuals faced criminal charges. The WorldCom accounting fraud, 2002. How it happened. The WorldCom accounting fraud involved a systematic effort to inflate the company's profits by misclassifying expenses as capital expenditures. WorldCom's management manipulated financial statements, leading to the fabrication of billions of dollars in fictitious profits. The fraud was exposed when an internal whistleblower raised concerns, and the company filed for bankruptcy in 2002, shocking investors and contributing to the erosion of trust in corporate governance. Damage to the public. The WorldCom scandal resulted in significant financial losses for shareholders, bondholders, and employees. It also had a detrimental impact on the broader financial market and led to decreased trust in corporate accounting practices. Punishments. CEO Bernard Ebbers was sentenced to 25 years in prison, and CFO Scott Sullivan received a 5-year sentence. The LIBOR scandal, 2012. How it happened. The LIBOR scandal involved the manipulation of the London Interbank Offered Rate, LIBOR, a key benchmark interest rate. Traders at major banks submitted false rates to benefit their trading positions or to make their banks appear financially healthier than they were. This manipulation affected trillions of dollars in financial contracts worldwide, from mortgages to derivatives. The scandal was exposed through regulatory investigations, leading to substantial fines and legal actions against the involved banks and individuals. Damage to the public. The manipulation of LIBOR affected the terms of financial contracts for countless individuals and institutions. Borrowers and investors experienced financial consequences due to the artificially set interest rates. Punishments. Several banks paid hefty fines, and some individuals faced criminal charges and were sentenced to prison. The Volkswagen emissions scandal, 2015. How it happened. The Volkswagen emissions scandal was a result of the company's deliberate installation of software in its diesel vehicles that manipulated emissions tests. While the vehicles passed tests in the lab, they emitted far higher levels of pollutants in real-world driving. This fraudulent scheme was exposed when researchers and regulators discovered the software manipulation, leading to massive fines, lawsuits, and a significant hit to Volkswagen's reputation. Damage to the public. The scandal damaged the environment and public health by allowing vehicles to emit pollutants above regulatory limits. It also harmed public trust in the automotive industry and raised concerns about corporate ethics. Punishments. Volkswagen paid billions in fines and settlements, and some executives resigned. The Parmalat scandal, 2003. How it happened. The Parmalat scandal was a case of massive corporate fraud in Italy. Parmalat's executives inflated the company's assets and profits by fabricating transactions and creating fictitious bank accounts. This enabled them to hide the company's huge debt burden. The scandal came to light when Bank of America refused to transfer funds to cover a Parmalat bond payment that was supposedly backed by a non-existent account. The discovery of Parmalat's financial irregularities resulted in one of Italy's largest corporate bankruptcies. Damage to the public. Shareholders and bondholders suffered significant financial losses as Parmalat's stock price plummeted. The scandal also had broader implications for Italy's financial markets and reputation. Punishments. Several executives were arrested and sentenced to prison. Parmalat's founder, Callisto Tanzi, received a lengthy prison sentence. The Barings Bank collapse, 1995. How it happened. The collapse of Barings Bank resulted from unauthorized speculative trading by one of its employees, Nick Leeson, in the derivatives markets, particularly in the Nikkei 225 futures market in Singapore. Leeson's trades incurred massive losses, which he concealed through fraudulent accounting entries. His trading losses ultimately surpassed the bank's entire capital, leading to the bank's collapse. Leeson's activities went unnoticed until it was too late to rescue the bank, leading to its sale to Ingroup. The scandal highlighted the importance of risk management and oversight in the financial industry. Damage to the public. The collapse of Barings Bank resulted in financial losses for clients, shareholders, and the bank's employees. The reputation of the bank was tarnished, and the broader financial industry had to re-evaluate risk management practices. Punishments. Nick Leeson was arrested, convicted, and served prison time for his unauthorized trading activities. The annals of financial history are replete with tales of ambition, greed, and the staggering consequences of unchecked power. We've delved into 10 financial scandals, each with its unique origins, far-reaching damages to the public, and varying degrees of justice served. These stories serve as a stark reminder that the world of finance is not immune to human frailties, and that maintaining integrity, transparency, and robust oversight remains paramount in safeguarding the trust and stability of our financial systems. As we bid adieu to this exploration of financial scandals, we hope you've gained valuable insights into the past while pondering the lessons that shape the future of financial accountability.